Friday is when earnings season officially begins, and we could have some real fireworks on our hands, which is what happens when you get gigantic runs in stocks that don't necessarily have all that much good to say. Take Wells Fargo. Now, we've got a huge position in this one for our Charitable Trust, which you can follow by joining the CNBC Investing Club. I urge you to do that. It's a lot of fun. We do a lot of good stuff. Now, I think 2022 could be a much better year for Wells Fargo than any year since 2017. It's not clear to me that the stock can keep rallying, given that it's already jumped 14% in the past week to 52-week high, like so many others. But I think if it pulls back, we're going to just keep telling you to buy it. You've got to stay tuned to your club bulletins. Then we get to hear from BlackRock, which has surprised endlessly to the high side. You'll get a great analysis of the world, not just the bank, not just his business, from CEO Larry Fink when he explains how well his company's performed in the last quarter of the year. I know I make it sound like there's no guesswork here, but historically, there really hasn't been. This is just a sensational company led by a sensational CEO. Then there's Citigroup. Is this a new and improved Citi? You wouldn't know it from the stock, which has lagged helplessly during one of the great banking rallies I've ever seen. Can CEO Jane Fraser tell a tale that makes the stock catch up? Honestly, I just want to understand how the company isn't allowed to buy back stock every share it can want to, because the stock's so cheap versus what's known as its tangible book value. Citi said it had to pause the buyback in a speech in December because of an arcane regulation. I want to know more about that. Capricious government or wayward bank? We need to know. Finally, let's end with a bang. J.P. Morgan, Jamie Dimon. Jamie will tell us what the heck is going on in the banking and in business, in both domestically and around the world. I love his commentary because I get to crib from it for months on end. That's how good it is. Jamie, who's one of those execs that everyone calls by their first names, tends to be very optimistic, but he also mixes in a few Molotovs along with his otherwise easy-to-down economic cocktails. It's a bit of an odd time right now, almost as if many stocks have to take their medicine and then get back on track. This week, we saw the unprofitable techs get a drubbing, which then spread into the more mature, profitable ones. And at the close today, well, it made me feel like that the despair is beginning to hit that nasty level that often signifies a bottom. In the meantime, the industrials and the banks were red hot. At this point, it might actually be worth it to circle back to the techs that aren't too expensive, as the biggest industrials finished the week with declines. That was a signal that maybe they've peaked. It's a bad rotation. I will help you with that later in the show. Will the buyers ever return to the profitless SPACs and IPOs that were pumped out willy-nilly by greedy bankers and their venture capitalist compadres? The bottom line, maybe that'll happen one day. But it's a heck of a lot easier to buy the stock of an established company that's actually making money. Yep, earnings are what matters again. Tangible GAAP earnings. Who'd have thunk it?
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.